Hello friends, hope you are doing good. You invested 10 lakh in a mutual fund and now the value is 15 lakhs. If you withdraw now, how much you need to pay as tax? What is long-term capital gain and short-term capital gain tax in mutual funds? Do you know that after 1st of April 2023, few changes are made to tax rates for debt mutual funds and there is a difference in dividends also. Now the tax categories have increased and it's little confusing. Can you plan and save tax by investing in mutual funds? How efficient is mutual fund taxation compared to fixed deposit or real estate? If you are a mutual fund investor and worried about how tax affects your returns, what kind of taxes you could be paying, how to adjust your losses against profits, and what happens when you receive dividends, all these questions will be answered in this video. To get updated on personal finance and to grow your money, subscribe our channel and press the bell icon. I am Kiran Kumar M and welcome to You Can Invest. For resident individual, when you keep money in a fixed deposit, whether you withdraw it or not, on accrual basis, you need to pay income tax. Whereas in mutual fund, only when you withdraw the funds, you will be paying the income tax. In mutual funds, the only difference for NRIs is tax deducted at source or TDS. Otherwise, tax rates are same as resident individuals. For example, you keep 10 lakh rupees in FD and same way invest 10 lakh in an equity hybrid mutual fund. After 1 year, let's assume you get 7% interest in a FD and 7% return in a mutual fund. Whereas, while filing income tax for 70,000 interest will be added to your income even if you don't withdraw money. And if you are having a taxable income and your tax slab is 30%, then you are paying 30% tax on 70,000 rupees of FD interest. Whereas, if you withdraw rupees 70,000 profits from mutual fund, your tax will be zero. Now, the biggest question is whether mutual funds are tax efficient. Can I plan my withdrawals and reduce my income tax on profits? We will see the details shortly. But before that, if you are not sure about basics of mutual fund and its categories, I have given the link in the I button and in the description. Please watch the video about categories and basics of mutual fund. There are 4 factors determining the taxation for mutual funds. One is the types of mutual funds are divided into 2 groups for tax purposes: equity-oriented mutual funds and debt-oriented mutual funds, and one more special category we will discuss in the next chapter. And capital gains. When you sell a capital asset for more money than you purchased, you make a profit known as capital gain. The third point is holding period. The tax you will pay on the capital gains depends on the holding period. There are 2 types: short-term capital gain and long-term capital gain. Taxes will be less if your holding period is longer because India's income tax laws encourage longer holding period. The fourth is the dividends. A dividend is a portion of accumulated profits that the mutual fund house distributes to the scheme's investors. Investors do not need to sell their assets to receive a dividend. Types of funds and capital gain tax. The first category is the equity mutual funds. An equity scheme is a fund that primarily invests in equities and equity related instruments. A mutual fund is categorized as equity fund when domestic equity securities exposure is more than or equal to 65%. Some examples of equity funds are multi-cap funds, flexi-cap funds, mid-cap funds, small-cap funds, and equity hybrid funds, and many more. When the holding period is up to 12 months, then a short-term capital gain tax will be applied and the tax rate is 15% of the profit. TDS is applicable for the NRIs at the rate of 15%. When the holding period is more than 12 months, then 10% tax without indexation is charged over and above 1 lakh profit. Let's take one example that I have invested 10 lakh before 2 years and now the value is 15 lakhs. In this case, my long-term profit is 5 lakhs. When I withdraw total 15 lakhs, then for the 5 lakh profit, 1 lakh is exempt and for the 4 lakh profit, I will be paying 40,000 tax at the rate of 10%. For NRIs, a TDS of 10% above 1 lakh profit will be done. Debt mutual funds. When the mutual fund scheme is having domestic equity exposure up to 35% and you purchased on or after 1st of April 2023, the schemes will be categorized under debt mutual funds. Some examples of debt mutual funds are liquid funds, ultra short-term funds, low duration funds, or international equity funds, fund of funds, or credit risk funds. In this category, if the holding period is within 12 months or more than 36 months, whatever profits are made by selling the units will be added to your income and you are required to pay the taxes as per your income tax slab. There is one more category, a special category of mutual funds. When a mutual fund is having domestic equity securities exposure up to 35%, which is acquired before 1st of April 2023, and 35% to 65% exposure in the domestic equity securities acquired any time comes under this special category. In this, when the holding period is less than 36 months, a short-term capital gain tax will come, which is your applicable income tax slab rate. In the example above given, mentioned as 30%. For the holding period of more than 36 months, a long-term capital gain will arise, which is 20% with indexation. For example, let's take I invested 10 lakh rupees for 36 months back, and with the 7% compounded return, my value will be rupees 12 lakh 25,000 and 43. If my indexed value with cost inflation index is 10,97,779, then I will be charged 20% on the difference of these two amount, that is 1,27,264, which is rupees 25,450. As told earlier, if I kept the same amount in FD, then for the interest of rupees 2,25,000 rupees 43 with a 30% tax slab, I am supposed to pay rupees 45,000. Still, compared to FD in the special category mutual funds may be very tax efficient. Dividend income. As a mutual fund or equity investor, you may be unsure about how to treat dividend income while filing your income tax return. Whether you need to pay tax on dividend income, Finance Act 2020 shifted the taxability on dividend income from the hands of the dividend declaring company to the individual investors. After the abolition of the dividend distribution tax, that is DDT, the taxability of dividend income is now in the hands of the investors. Now, whatever dividend is received from the company or a mutual fund house is treated as a income and will be added to the taxable income. While paying the dividend now, normal rate of TDS is 10% on dividend income paid in excess of rupees 5,000 from a company or a mutual fund. Finance Act 2020 also provides for deduction of interest expense incurred against the dividend. The deduction should not exceed 20% of the dividend income received. By now, we have understood what is short-term or long-term gain and losses. Adjusting losses with the profits is possible and it is setting of capital gains. But for that, we need to follow some rules. The first rule is that short-term or long-term capital losses cannot be set off against any other source of income. This means you can't use capital losses to offset income from sources like salary or interest. The second point is that a loss arising from short-term capital asset can be set off against the gains arising from the sale of long or short-term capital assets. Third is that a loss arising from a long-term capital asset can be set off only against the gains from the sale of long-term assets. The fourth point is any loss under the head capital gains, whether short or long-term, can be set off only against income from the same head, that is capital gains. It is important to note that you can carry forward a capital loss for up to 8 years from the date of the loss. This means that if you have a capital loss in 1 year but don't have any capital gains to offset it against, you can use it to offset capital gains in the future years. At the end, I would like to say, as income tax is charged only when you withdraw money from mutual funds, it is very easy to plan and reduce the tax burden. Hope the information shared will help you to know your taxes on withdrawal from mutual fund. I thank you for watching till the end. If you still not subscribe our channel, subscribe now, which motivates us to create more such informative content in personal finance. Also like the video and comment. See you shortly in my next video. Till then, happy investing.